Okay, welcome everyone to our next panel. It's sustainability focus, investing to achieve net zero. The question we've been asking here at Bloomberg is, in the race to achieve net zero, where we should be putting our money. And to answer that, we have Hubert Keller from Lombard Odier. He's Senior Managing Partner. Thanks for joining me, Hubert.
Thank you.
Before I get carried away with my own questions, I'm sure that everyone has their own questions in the audience, so please do send them in using the QR code. Don't forget to do that. And you can get involved with the hashtag BloombergInvest. We've brought you to discuss sustainability, but I've got to ask you, you're based in Switzerland. How confident are you in the sustainability of Switzerland as a banking centre?
Thank you. I always knew over the last few days that being the only Swiss banker on the panel was probably going to attract a few complicated questions. So I think it's really important to keep in mind, of course, the Credit Suisse situation is very unfortunate, but it's very important to keep in mind that Switzerland as a financial place has been built on the strength of its wealth management franchise and particularly on the strength of its cross-border wealth management franchise. I think it's really important to keep this in mind. Switzerland is the largest place for cross-border wealth management in the world for a number of reasons that have not changed with Credit Suisse. And those reasons are linked to the political stability of the country, of the economic stability, of the expertise in banking and in wealth management that has been built over so many decades, even if not more. And those attributes remain in place. One would argue that the way that the Swiss authorities have dealt with a very complicated situation so swiftly and so rapidly is probably another evidence of the stability and the solidity of the financial place. And I think another important point to bear in mind, the Credit Suisse wealth management franchise is a very strong franchise. And the problem of Credit Suisse came from the global markets and the investment banking side. So, you know, I certainly belong to those who think in Switzerland that we need to continue and we should continue to strengthen and invest in our core expertise, which is cross-border wealth management. And I'm still quite hopeful and feel that this is going to be a very sustainable value proposition for the future.
And you've been a strong advocate of the green investment opportunity. Are you using your green credentials to try to woo some of Credit Suisse's clients over to you?
Look, there is no doubt that there will be some changes with clients as a result of this situation. And the reason is that most wealth management clients or wealthy families, they tend to want to bank with a few banks. So there is going to be a diversification effect, which indeed is likely to benefit the rest of the wealth management industry in Switzerland. But again, overall, it's a very unfortunate situation.
And how far are you looking past all the negativity now and actually thinking about positioning for the pivot? Because we know that the days lost now equal years in terms of catching up later.
So, this is a really interesting point. We obviously, Lombard Odier is an investment firm, and we manage money for private clients and institutional clients. And as an investment firm, we indeed are very focused on all of these short-term considerations that are really complicated, ranging from inflation to monetary policy, obviously the geopolitical situation, and now perhaps the issues arising in the banking system. What we are always saying to clients is that when you look past these short-term issues, we think that we are in front of basically a green economic revolution, which could become the growth story of the next 2 decades. And very much like, frankly, tech or IT and tech revolution has been the growth story of the last 2 decades. And it's really interesting to understand how things are developing. And I think we have a tendency of underestimating not only the scale of the environmental issue, but also the scale and the speed at which innovation have come through. Because climate and the environment has been such a big and recognized problem for so many years, actually, we've seen a lot of innovations in the last few decades to try to basically address this problem. In fact, I would argue that climate and environment have attracted a lot of the innovations. And what is also quite interesting is to really understand how innovations go through the economic system. And obviously it starts with innovation, it moves to niche market, and then at some point, there's an inflection point that is crossed. And when that inflection point is crossed, that innovation moves into mass adoption. That's where the scale story comes through. And this is the place which is really interesting as an investment or for investors. The interesting point is that this inflection point normally requires a few criteria. And they are always the same. It's about price or affordability. It's about whether the new solution is more efficient than the incumbent one. And it's also about accessibility. And when you look at the environmental issues at large and climate specifically, what is really interesting, which is again very underestimated by a lot of people, is the fact that 90% of the solution to sort out the environmental crisis today exist. 90%. And some of those solutions have already gone through this inflection point, like the building blocks of electrification. And we see this sort of scaling up of these solutions, and many others are between 2 to 3 years, we think, of crossing these inflection points. And that's really quite interesting because the reality is that when these innovations or these green technology solutions start to scale, which again we are seeing right now as we speak in the building blocks of electrification, then they attract a huge amount of corporate investment capex, because then the business case for companies to start to invest becomes very clear, and they often lead to considerable changes across economic systems and lead to profit pool shift. And again, we've seen that again with the internet revolution in the last 20 years. It has completely changed entire industries and shifted profit pools around and changed economic systems. And that's, as an investment firm, why we get quite excited about it, as you can see.
So I want to take the temperature in the room and see if everybody's as excited as you are. We're going to do a live poll. And the question is, are you convinced by the opportunities presented by the green transition? Yes or no? So if you scan the QR code, you can tell us what you think, and we'll come back and get the result in a bit. Hubert, in your view, as you say, economics is the major driving force behind this green transition forward. How important then is policy action? Is it as important?
It's a really good question because a lot of the discussion is around policy action. And policy action is important, but it's really important to bring forward this inflection point. The scaling up of green solutions, green technologies, is really going to be down to the law of economics. So what, if you take, for example, I don't know, heat pumps in the US, heat pumps cost $10,000, whereas gas-fired boilers cost, I don't know, $7,500. So to have a green subsidy of $2,500 to basically, for each one buying a heat pump, is going to shift the demand towards heat pump. And that's going to be very helpful because over a 3 to 5 year period, the cost of heat pumps are going to go down. They're going to become on their own more economic than the incumbent solution. So effectively, policy action is helpful to bring forward these inflection points. Absolutely. But again, when we look at what's happening with electrification today, it's gone much beyond policy action. It's important to realize that our entire energy system, the demand for our energy, basically 95% of the demand is concentrated around 3 clusters: mobility, buildings, and industries or industrial processes. And what is really interesting is in some of these clusters, like mobility, but it's also true in buildings and industry to some extent, we are moving towards the green solution. If you take electrical vehicles, for example, there is a faster and faster adoption of electrical vehicles in the world. 10 million electrical vehicles have been sold this year. That's about 12%. We think in the next 3 years, it's going to be 30% of new car sales. And they are being adopted because, again, affordability, accessibility, and efficiency. And those are the reasons why these sort of green solutions are being adopted. And this is the reason why the demand for energy is starting to become much more about electricity. As the demand is shifting, then we see the potential of unlocking renewable energy supply for a very simple reason, because as the demand for energy is being electrified, effectively the cheapest source of electricity today is solar and wind combined with, obviously, batteries. And this is why all new electricity supply in the world today, 90%, is done through solar and wind. And this is, again, the law of markets that are at play because it's cheaper and because there's more demand of electricity, there is more solar and wind being deployed.
I think we've actually got a chart of power by generation sources as they currently stand. So this is according to Bloomberg NEF data. And let's also just get the results of that poll that we did. Are we convinced by the opportunities presented by the green transition? Hooray, you're winning.
Oh, so far. Still have 40%.
57% say yes, 43% say no. So more work to do.
More work to do, yes.
We've also got some questions from the audience. Someone says, what innovative alternatives have emerged to finance the multi-trillion renewable energy financing gap?
So I think it's a really good question. And the reality is that I'm not sure there is much innovation around this. The reality is that as these solutions, and we can really see this with electrification, are ready for mass adoption, the business case for investment capex to be deployed is becoming very clear. We think as a firm that there is going to be 24.5 trillion of corporate investment capex being deployed as we speak between now and 2030 to finance the electrification of the economy. Electrification is going to be extremely capex intensive. We need to basically lay out 140 million kilometers of transmission distribution cables. The list is really, really long. But the reality is that because the business case is becoming clear, there is now corporate capex ready to be deployed and being deployed. And as investors, this is really interesting because when investment capex are being deployed from corporate, it is because they are investing in future earnings of their own. They're investing in the future growth of their own P&L. And so as investors, basically, we want to follow these capex. And it's really interesting when you look at electrification, we think this 24.5 trillion is going to translate into 3.5 trillion of investment capex being deployed this decade. And if you look at the tech revolution, we were also looking at 3.5 trillion of capex being deployed year in, year out for effectively more than a decade. And that is also quite interesting because if you look at sort of 20, 25 years ago, or maybe even more, the share of earnings from tech companies were 5% in the global economy. It went to more than 20%. And this is just to give you a sense of the scale of the opportunity around the green transition. And CapEx is being deployed as we speak.
And finally, a last question from our audience. Do you think the green revolution you describe can be achieved in Europe under the SFDR regime? Sam Turvey at Advisors Maitland says there's some negativity around it.
So I think, so when we speak to clients, we always try to make a distinction between two very different discussions. The discussion that we just had is about green alpha, and it's about investment returns, and it's about investing in companies that are well positioned to capture these new profit pools that are going to emerge or arise as a result of the environmental transition. That's the green alpha discussion. There's another discussion which we want to have with clients, and this discussion is where, frankly, most of the focus is on the regulatory side, on the media side, and the general public, which is how much of my portfolio is contributing to the environmental transition. It has a notion of positive contribution. These two discussions are distinct and completely separate. So what SFDR is trying to do is to basically engage in that second discussion. And we very much welcome what's happening with SFDR and with the EU taxonomy in particular, because it is encouraging our industry to create transparency on how much portfolios are actually contributing to the environmental transition. And it's forcing our industry to move away from what I would refer to be the sort of ESG 1.0, which is just about data and it's about business practices. It's about how companies do things as opposed to what companies do and whether in what they do they are really contributing to moving this transition forward. And I think what SFDR is doing, frankly, very much with the support and backed by the incredible work done by the EU taxonomy, is trying to create transparency on how much portfolio are contributing to this environmental transition.
All right, well, that's all we've got time for. Hubert, thank you so much for joining us. It's been really fascinating, and I hope you can win round that 43%. Please give it up for Hubert.
Thank you. Thank you very much.